record button first before you go to presentation mode. Hey, good afternoon. It's Dwayne Richards, your trusted CPA and enlightened accountant. Today, smaller group, but still the meat of it. We're gonna do a shorter version of the 7 ways to pay less tax. And just so you know, this isn't not getting you through tax evasion. You know, tax evasion is illegal. Tax deferral is the main here in Canada. Your main thing is deferring tax to a later point in time when potentially you're in a lower tax bracket. There's also some immediate tax savings when it comes to tax. Let's touch on some quick highlights of the difference between a tax credit, non-refundable credits, tax deductions, why you want to be like our guests today who have businesses or side hustles, and the advantage of being a business owner versus just a regular 9-to-5 employee like I was for 20 years. Yeah, there's today's presentation pretty quick. 7 ways. There's lots of ways, but these are kind of 7 of the top kind of high-level categories that average Canadians can implement, probably at least 3 to 4 of them. And you can probably find at least 1 of the 7 that you can start doing tomorrow or today. All right, let's get into it. Jump over to the presentation. It's actually my first time doing a presentation using Canva, so patience, please. So 7 ways to pay less tax. That's right, my name, Dwayne Richards. I am a licensed CPA, tax specialist based in Toronto, serving taxpayers in Canada. All right, so just everyone likes a little quick agenda just to say where we're going. Actually, there's 8, and I'm going to give you a bonus one right up front. So around a voluntary tax. You're like, what? Voluntary tax? Yeah, that's the bonus number 8. A lot of these groups, Ash as a financial advisor, a lot of these things you'll check off the box that you probably talk with your clients about. RSPs, guess what? There's no surprises in Canada. RSP, whether you like it or not, that's still our #1 way to save, defer, delay tax payments. Things like tax-free savings accounts and RESPs. Yes, they are tools. No, they aren't on your tax return, but they are great tools. I'll share a quick little story of an article I just saw in the Globe and Mail yesterday that just blew my mind. I'll share that with you then. Available credits, like I said, the difference between credits and deductions. So available credits that a lot of people just forget that they're available or that they're eligible. Income splitting. This one may not be for you, but income splitting is for as we move into retirement, and if you have a spouse. All right, I'm going to let somebody in. Hopefully they don't disturb us, but they did get here. I'm just going to pause briefly. Hey, welcome, and we're just getting started. So we're just right off at the top here. Just going through the agenda for today. So number 4, income splitting. Number 5 is capital gains, and probably heard lots of stuff going on in the media or not around the upcoming or the new changes in the capital gains structure. Number 6 is tax efficient investments. Again, Ash might be valuable, might grab a thing for you for one of your clients. And then number 7 is the self-employed tax deductions versus credits. All right, that's pretty good. We'll just jump right into it. There's just a little bit about me, a nice photo of me wearing a suit. I was dressed up on Saturday. I did have that suit on. Actually, I was wearing that exact outfit on Saturday. The suit still fits. I am a CPA tax accountant based in Toronto, Canada. Voluntary tax, just a little bit of fun. You know, we can have fun with taxes. Everyone knows about OLG, the Ontario Lottery and Gaming, buying a lottery ticket, right? Like sometimes that's people's plan B, or maybe that's their plan A, is buying lottery tickets now twice a week, right? So like a lot of max Tuesdays and Fridays. You don't want to just buy a ticket once. Like, what if your numbers come up on Friday, Larry, and not just Tuesday? You didn't buy a ticket on Friday. And then what if anyway, it's a voluntary tax. The chances of winning are pretty small. The good news is that's a big fundraiser for OLG. A good chunk of that money does go to paying paying charities. It's a voluntary tax. People are voluntarily paying like $10 to $12 a week. If I just said $10 a week, that's $520 a year in a tax. Like you're giving money to the government, but that's choice. You're buying a little bit of hope, I'm guessing. But hey, who am I to say? I did make an offer last month. I have to follow up. I actually said, hey, if you want, let's start an investment club and just give me the $5. We'll buy one ticket and we'll pool our $5. So I still put that out there. If people are interested in creating some kind of investment club, obviously not licensed by like the OSC or I'm not licensed by as a licensed buyer, but you can have a private club. So anyway, that's just a quick little bit of fun to say, hey, taxes can be fun. And sometimes we actually volunteer to pay extra money. On that note, actually, I didn't even put it in here, but just on that note, people voluntarily, I have clients that voluntarily pay more for one of two ways. Actually, it's really one way. One way that clients voluntarily pay more to CRA. Anyone want to guess? 10% more? Filing late. Filing late. You file late. You file after the April 30th or the June 15th date, and you're voluntarily paying an additional 10% if you owe tax. On top of the 10% interest, or 10%, interest on the late payment. Also, if you're getting a refund, I have a client right now, he's got about an $18,000 refund, and we haven't filed his taxes yet. You're giving that money to CRA. CRA's not paying him interest on that money that's sitting there. So that's kind of a bonus number 9, is that we just kind of, through procrastination or just overwhelm, not filing taxes on time. But the real meat of it is, number 1 is RSPs is still the number 1 way to defer taxes for Canadians. When I talk about deferral, is like, yes, you get the tax refund on the way in, but you pay tax on the way out. And it's super important to do a bit of tax planning, just on a high level tax planning, to understand which tax bracket you're in. If you're making, I tell my young clients, if you're making less than $60,000, probably not the best bet to put money in your RSP today. It's better to use option 2, which is put money in your TFSA, specifically if I think at some point, 5 years or so, you're going to be earning more. Save that tax RSP room for when you're in a higher tax bracket. And for sure, if you're in the over 150K a year, definitely it's time to put money into your RSP, because chances are when you retire, you're not going to be in the $150,000 tax bracket. So you'll be paying less tax on the way out than what you got on the way in. So that's, again, if you have questions, we're not going to solve all the problems. We're not going to give you the how-tos, but just to make you aware of, if you're already contributing to RSPs, I don't have to explain to you. If you're not, just raise your hand and we can, talk about that after. Tax-free savings accounts. Advisors and accountants love acronyms, Larry. We love acronyms, but let's break it down. So tax-free savings account, the TFSA, it's been around for a while. If you're my age, you probably have close to $90,000 of contribution room. RESPs is for children. My sons are actually, I'm just about to do a withdrawal. The biggest mistake most people don't is actually understanding how you can actually tax efficiently do the withdrawals. You can actually request on an annual basis how much contribution, how much grant, and how much income you pull out on an annual basis, because only the grant and the gain is taxable. The contribution is not taxable to your child. So there's a form when you're pulling money out of like a Scotia or a bank self-directed account, there's a form and you can actually specify how you want that money split to do a little tax planning for your child. TFSAs, tax-free savings account. Quick story. There's an article in the Globe and Mail this week. There's a husband and wife who are teachers. You like this, Ash? I don't know how they did it, but somehow they've built up a $2 million balance in their TFSA that's producing $15,000 a month. A month, $15,000 a month in dividend income. Whoa. I'd like to know who they're like, how like they should become financial advisors. Quick
Absolutely.
tip though, just from a tax point of view, why it's great to work with a tax accountant is Revenue Canada is going after some like financial professionals. So if you're a professional, like a licensed investor, you're not supposed to be day trading in your TFSA. And if you're like an active trader in the TFSA, they can come after you for taxes. It's really meant as a like a long-term savings tool, tax efficient tool. You're not supposed to be like probably option trading or like day trading in your TFSA. Somehow these people like, I guess if they bought Apple, like again, over the last 15 years, if you made some really good investments, somehow they got it to 50 to 2 million. That's awesome. Because probably the max that they put in was close to 100K each. So anyway, and the new one is the first home savings account. You have to open an account. You have to be eligible. 18 years and older, same as your TFSA, 18 years and older. The first home savings, you actually have to open the account before you get the contribution room. A couple of my clients, she kind of made the mistake that she just opened it this year and forgot to open it late last year. But she gets $8,000 of room, up to $40,000 per person for extra first home savings account, in addition to putting money into your RSP and pulling money out of your RSP as a first-time homeowner. So there is a bit of a plan between a couple, a husband and wife couple, using the two strategies. You could save upwards of $200,000 tax efficiently for a deposit on as a first-time homeowner using the first home homeowners plan and the RRSP. Okay, I think that's good for now. Available credits. So this is, again, just to kind of get you thinking and just realizing that tuition credits. So, for example, my son is in his third year at Western. University students get a T2202 gets issued with tuition. The big thing is, remember, it's kind of based on term. So even though you might pay for tuition up front, that first year, they're only in school for 4 months. So you only get 4 months of tuition in that first year. And also on the back year, like that last year, you're only in school that 4 months of the last year. So it's really having a strategy of when do you pull money out of the tax-free saving or the education plan, the registered education plan, take some more money out early because chances are they didn't have a lot of income, but take out more in years kind of 2 and 3, not so much for taking out in year 4, because that last tax year, you only have four months of tuition. Disability tax credit. So again, there's a whole process of getting the disability registered, a form, working with your doctor. Once it's in place, though, you can go back to first diagnosis. You can go back as far as 10 years, and it's a rolling forward. And sometimes you have to just make sure if it's renewable to remind you, like to document which year you have to go and get it renewed if possible. Just a quick tip, if anyone's a type 1 diabetic, Revenue Canada, wow, they finally got to like updated their policy to say type 1 diabetics will be pre-approved or automatically approved for the disability tax credit. That wasn't the case before. They actually had to go through the full application if you're a type 1 diabetic versus type 2. Medical credits, again, keeping just as a quick tip, if you have seniors, if maybe it's you or your parents are in a nursing home, long-term care facility, the institution will issue a tax receipt, and that can actually be claimed on not just under the Trillium amount, but it can actually be claimed under the medical expenses. And if you're eligible dependent, if they are your eligible dependent, you can claim that amount on your tax return, not just on theirs if they don't have enough taxable income. I have a couple clients that we do that for. Donations, again, same with medical and donations. If it's a husband and wife, pool your stuff together and put it on. Donations go on the higher tax earner. Medical expenses usually go on the lower tax earner, and there's a strategy, most of the software does that, but put the two together, especially for donations, because you get a certain amount for the first $200 and then more for later. Also, I have to do a little bit of research, but I think as we have elections coming up, there's actually, you get kind of more bang for your buck for political donations. So, if you want to have there's a political party that you favor, I believe the political donation kicker or credit is a little bit greater than just a donation to, not just a donation to, say, your favorite charity like United Way. Good to do both, but if you're looking to kind of maximize your tax benefit, the political contributions may have a slight advantage that way. Everything good so far? But we're going to kind of hold questions to the end, but just if I lost you along somewhere, just kind of write it out and we keep going here. Income splitting. So income splitting is more as you hit retirement and you're approaching like 60, 65, and it's really based on you have to have pensionable income to be able to split. This comes up, the main one is around pension income. So again, I have a couple clients that have like RIFs. So again, a RIF is you have your RSP, and at age 70, it gets converted into a retirement income fund, named a RIF. You can then split. So if you have a primary earner and someone who, you can move some of that money to balance out the tax brackets. That's the key. Canada pension plan is a little bit different. So like, for example, my dad was a teacher, primary earner, and then you can actually fill out a form and you can actually transfer some of the Canada pension to be taxable to a spouse if you had a spouse that was a stay-at-home parent, or didn't necessarily, was maybe self-employed, didn't contribute to the Canada pension plan. So it's a separate form for Canada pension plan, different than the pensionable income you can just do in the tax return. Canada pension plan, you actually have to submit a form through CPP, through your Service Canada. I'll talk about that quick in a second. The third thing is a spousal RSP. So again, I have some clients that where the one spouse is a significantly higher earner. The advantage that they can do is open up a spousal RSP. Now the tax deduction on the way in is still only theirs, but the idea is after 2 years, that income in the spousal gets taxed on the withdrawal, gets taxed to the spouse, ideally in a lower tax bracket. Again, our goal is at 65 and older to have two balanced incomes, as opposed to someone that's in the 53% tax bracket, someone who's in the 0 tax bracket. The system is not set up for there's not games, but you have to be a little bit more proactive in managing, balancing the tax brackets per family. A little strategy around Canada pension plan. It's a good idea early on to actually get registered. It's a separate account. It's your Service Canada account, not your CRA account. It's a good idea to actually get logged in, check your balance. It's also kind of fun to see how much money will I be getting at the different ages. And once you log into your account, they'll show you at age 60, 65, and 70 what your CPP payout is going to be. And just FYI, it can take up to 120 days for them to start paying you out. So if don't necessarily wait till your 61st or your 65th or 70th birthday, say, I want my money now, it's because it can take up to 90 to 120 days. So I always recommend clients to kind of start you don't have to take it then, but at least get your account logged in and set up, and also just checking that your annual contributions, especially if you're self-employed, make sure your annual contributions are being put into your account too. You don't want to wait till you're 65, 70 and realize there's no money in your account. That's not great. So I have a little how-to on how to do that. If anyone's curious, you can always message me to say, hey, how do I log in and get my Service Canada set up? Okay, capital gains. So again, kind of 3 different versions. There's cottages, rental property, and investments. So again, I'm not going to get into all the meat and potatoes details of it for today, but just to kind of say if a second property, so either a cottage or a rental property, if that is a second property, the rules are changing now. So it's the first 250,000 is at one rate, but if it's over, the idea is it's going to 2/3, not 50%, at your marginal tax rate. So it's that's a lot of make your head spin and makes your head hurt. makes accountants' heads hurt as well. But the advantage is we can actually work through some scenarios with you. There's some things around rental properties as well that, like, if it was your principal residence and then you've converted it to a rental property, there's some forms and different things that you need to make sure you do some homework as you do it. All comes back to documentation and really having a strong document, like tax file, making sure that things are including like cottages, the original purchase price, fancy things like ACB, which is adjusted cost base. So what things did you put into the cottage, new roof, like maybe you built the cottage from scratch, to figure out what's that, all that stuff that went into the cottage and versus the value of the cottage on the back end. Investments, capital gains, but there's also a strategy around capital losses. And that's more come December as you look at, say, hey, and this is specifically in an open trading, self-directed trading account. Not, guess what? Every investment's not necessarily a winner. And if you have some companies that you like, but they're just at a loss, there's a strategy around triggering capital losses at the end of the year. And those capital losses can be pushed back to previous year capital gains. Capital losses can actually be applied to rental capital gains or like real property capital gains. So it's really, it's just before you jump into being like a rental, like a landlord and some real estate investors, it's always a good idea to talk to the accountant and say, what's my short-term and long-term tax on these things? I have a bunch of clients that became like rental, like landlords, and they have no idea the potential tax, I wouldn't say nightmare, but just complications that they could be walking into. All right, capital gains. So again, we're not going to get into all the stories of capital gains, but again, just saying of the 7 strategies, if you have a cottage, rental property, or investments, just to be aware, there are some additional tax planning things that you can do to save some money. Tax fish, I didn't put any, no fancy little boxes or graphics under tax efficient investments. And that's, I just actually kind of stole it from the previous one, I guess, which is again using the tax losses. There's some other tax, and when it comes to tax efficient investments, it's again really understanding, kind of maybe start walking before running, and really just figure out what's generally it's talking to your financial advisor, portfolio managers to figure out tax efficient investments when it comes to not every investment is taxed as the same. Now I know what I was going to talk about. So for example, dividend income is taxed at a lower tax rate. But if I'm going to have that in my RRSP, you don't get that advantage because it comes out all as income. So you could have capital gains, interest, dividends, investment income all in your RRSP. It all gets taxed as earned income when it comes out. So if you're going to hold dividends, say, for example, you can't take stock advice from me, but if you were to hold like bank stocks, utilities, generally pay decent monthly, quarterly dividends, that dividend income, you want to hold that in a self-directed account because that dividend income you'll get on your T5, it's taxed at less than 100%. Interest income, you want to hold that in a TFSA or in a mutual fund because interest income is taxed at 100%. Capital gains, again, if you're holding stocks, you can hold stocks inside a TFSA tax-free. So if I'm holding bank stocks in my TFSA, the dividends plus the capital gain on the stocks are tax-free. So it's a good strategy to use that TFSA and choosing which products you're going to hold in the 3 different buckets. If I have a bucket of open trading account, TFSA, and RSP, you don't necessarily want to hold each investment in each of those, doesn't necessarily give you the same benefit. So there is around having that, understanding that, and talking to your financial advisor to get them to explain, to say, what's the marginal tax rate on the different types of income, and where is it best, what's the right bucket to hold those investments in? hopefully I've caused you a whole bunch of questions. My goal is to have you have more questions today, in which case you can just book a call with me and we can go more into personal detail. My goal is not to have you be able to do your own tax return after this presentation, but just simply be, hey, I need to talk to my advisor because I don't know. Right? It's okay to say I don't know. On the last one, we're looking at self-employed tax deductions. So really quick, I do a whole separate hour presentation on the tax advantages of being self-employed or having a side hustle. The key thing is with self-employed, and Ash said as a financial advisor, probably get this, you get 100% commission, so you get this nice commission amount. Before you calculate your taxes owed, you get to deduct deductions. Your cell phone, your internet, your home office, advisor fee, like your licensing fees, all that stuff comes. So you made $1,000, you deduct your $800 of expenses. Your net income, fancy word for accountants, net income is $200. You pay tax on the $200. You don't pay tax on the $100. You don't pay tax on $1,000. My people that are watching, if you're an employee, hey, you make 100 grand, and then the CRA takes theirs right at source, right? So they're taking off 40%. You get to take home 60,000, and they got their money, their CPP, yeah, all that. They got it first. Not so much when you're self-employed. The $1,000 is yours. You get to pay for your deductions and your expenses, and then your taxes calculated after. But it's always a good tip I tell my clients is don't forget though, like if you're self-employed and like there's no source deductions, so generally plan to pay 30%, like save 30% for the taxes. So the first dollar, it's yours, but it's not all yours because there's a thing called taxes. So just from a tax planning point of view, as you earn income as a self-employed person, it's a good idea to just move 30% over into a separate account. You may not need the full 30%, but it's just from a planning point of view, it's always good to put some of that money aside for when March comes and you have to pay your tax bill. All right. Yeah, thank you. I think that's it. Okay, that's a abbreviated kind of speed round version. And people are going, what do you mean speed round? That was like a lot. And I'm like, I know it's still a lot. Usually I throw a lot more, like more stories or we get more Q&A, but that's kind of a quick version. So if someone didn't show up today and they don't want to sit and watch for an hour, they get to watch a little bit less than an hour and speed through it. You get at least the highlights. And if you have any questions, you're more than welcome. If you're watching this on YouTube, more than welcome to just drop in a comment in the comment section, send me a message. More than happy to go more into detail, but that's at a high level, the 7 strategies to pay less tax. All right.